Welcome back, everybody. It's Friday, April 16th, 2021, and that means that once again it's time for the big picture. I'm your host, Neil Lyons, and in today's video, we'll be taking a closer look at the central themes driving the financial markets and analyze them in a way that makes sense, in a way that leads to actionable insights. So, a ton to get to today. We're going to be talking about the dollar. We're going to be talking about this recent pullback in yields, this spike higher in commodities, and what the implications of the sector rotations are telling us about the future direction of the stock market. So without further ado, let's jump in. See you guys on the other side. As per usual, we'll be starting the day by taking a closer look at the intermarket picture, right? We're going to be talking about the U.S. equities, U.S. dollar, 10-year yield, and commodities. Now, importantly, we want to be keeping track of the long-term, midterm, and near-term trends in these asset classes. So, starting with U.S. equities, we see that we're in an uptrend across all time frames, which is fantastic. The U.S. dollar, we're seeing this inflection point. This is something that we've been talking about a lot these last couple weeks with, obviously we're in a long-term downtrend in the US dollar, mostly in response to fiscal and monetary stimulus. In the midterm, we've been consolidating. So over the last 3 months or so, the dollar found a bottom and has just kind of washed around near those lows since then. So in the near term, as of last week when we were talking about this, we were in a pretty solid uptrend. What we're seeing that right now, the US dollar is in more of a near-term consolidation. So we saw some more pullback in the dollar this week. So definitely something to keep an eye on. For now, this recent pullback in the dollar just brings it to the bottom, the low end of its range, right? And let's take a look at that again. So back towards the low end of its range, but still a higher low in this near term turning into midterm uptrend, right? So does the dollar continue lower here and resume its prevailing long-term downtrend, or does it break out higher from here? That's going to have a number of implications for the stock market. Namely, if the dollar continues to weaken, that's going to support commodities prices. Because again, and like we talk about virtually every week, commodities prices and the US dollar are inversely correlated. Because when the dollar becomes weaker, it requires more of those dollars to purchase the same amount of commodities. Namely, things like oil and copper and things that our society needs. So down dollar is going to equal up commodities, or at least a tailwind for the price of commodities. It's also going to have an influential effect on the stock market. A weakening dollar usually boosts demand from foreign investors here in the United States, providing a tailwind for the stock market. So does the dollar go higher or lower from here? We're at this inflection point in the near term. We're at this inflection point in the midterm. So a lot to be keeping an eye on here. Next up, we have the 10-year yield, and another interesting move in here this week. So we're still in long-term and midterm uptrends in the 10-year yield, but we're seeing this change in the near term where we're getting some near-term weakness, and that's a pretty interesting chart. So let's take a closer look at that there. So here we have the TNX, the 10-year yield index. We see yields spiking over the last several months, right? Consolidating more recently, and then plummeting below the bottom of its range and over the last couple days, down 6.6% yesterday being Thursday, April 15th, right? Yeah, April 15th. So on a 1 week basis, down 6.25%. So that move basically because of the big move down yesterday. Now, as of today, it's bouncing back a little higher. We got to an extreme low there, but well below the lower end of its range. So a low probability move to be that violent to the downside yesterday, but a small bounce today tells me that, this near-term consolidation that we've been in the last several weeks since mid-March or so, showing weakness, and it looks like it's wanting to break out to the downside. So what caused that big move? Well, there was a big catalyst this week. We had fresh CPI data come out that had a big influence on investors' expectations of inflation moving forward, which in turn put downward pressure on the 10-year yield. So we're going to talk a little deeper about that here in a few minutes. Lastly, let's talk about commodities, where we also saw a change in the near term. So the long term and midterm, still solid uptrends for commodities, but recently we had seen some near term weakness in the space. Now, this week that changed, where commodities turned higher once again. Let's have a quick look at the chart to see what's going on under the hood here. We see, commodities pushing higher in the long term, consolidating here in the mid near term, and rocketing higher above the top end of its range this week. So, in my opinion, a reaction to the opposite move in the dollar, where the dollar has sold off pretty hard the last 2 weeks or so, moving to the bottom of its range, pushing commodities here to the top of its range. So some major moves in the main asset classes that drive the financial markets this week. So let's dive in a little deeper to talk about the implications of those things, take a look at some of the economic data surrounding those things, and how each of these asset classes has affected the stock market and the sector rotations within the stock market. Now, in my opinion, at the core of this big move this week was the CPI data, the Consumer Price Index, which is one of the main gauges of inflation. So let's have a closer look at that and talk about the influence that CPI data had on commodities, the dollar, this move in equities and yields. So on Wednesday, March 2021's CPI data was released. Again, CPI stands for Consumer Price Index. It's an indicator of inflation. It's a measure of the average monthly change in the price for goods and services paid by urban consumers. So it basically is a measure of the cost of things that we need and the change in those costs, right? So in a sense, it's a measure of the purchasing power of the dollars in your pocket. So we saw that there was a pretty substantial move higher in the year-over-year rate of change with a move up of 2.64%, right? We had that on a year-over-year acceleration of 74.46%. So what's that telling us? It's telling us that on a year-over-year basis, inflation is not only moving higher, but it's moving higher at a faster rate, at a faster clip, right? Same thing with sequential rate of change. So instead of looking at this year's data point relative to the same data point last year, like we do with the year-over-year rate of change, sequential rate of change just looks at the rate of change from the previous reading. In this case, the previous month, right? So the columns here are showing you the year-over-year rate of change, but the white line, that's the actual change in the value. So if we're talking about a sequential rate of change of 0.62% with sequential acceleration of 74.86%, that's the difference between this most recent data point and the previous data point here on the white value line. So we see that, both sequentially and year over year, the rate of change of inflation accelerating and increasing. But the thing is this, that's exactly what investors expected. So what the market's been worried about is inflation going to run so hot that it forces the Fed to raise interest rates to rein in that inflation? And the answer to that was not yet. Yes, inflation is accelerating, but it's not accelerating at a frightening pace yet. And the Fed isn't going to do anything about it yet. Again, their target is to hit sustained 2% inflation. So that's just really a fancy way of saying they want inflation to be 2% on average over, the look back period. So the last 10 years or so. Over that period, inflation has significantly undershot 2%. So we're going to have to go well above 2% to hit an average of 2% over that time period. So if we pull back our date range here, let's look at how this has trended through time. We see here's 2% line. We see that more often than not, inflation has undershot 2%. So we're gonna have to spend a significant amount of time above 2% to hit that average. We also got some Fed speak this week where basically some of the Fed governors were coming out saying that while they expect economic growth, they expect inflation to be subdued alongside that, mostly due to supply chain disruptions because of the whole coronavirus thing, right? And the world being on lockdown in a lot of places. So that's kind of one thing that's subduing inflationary pressures. We also have to consider total cap utilization, right? And we talked about this, I think 2 weeks ago here in the big picture, where the US economy still isn't at full capacity. Last I checked, we were at like 75% of capacity capacity, meaning that, as the coronavirus lockdowns subside and there's a return of demand, companies can easily meet that increase in demand because they're not utilizing their full capacity right now, right? So if they're only using 75% of their capacity and there's more demand on the horizon, they can easily ramp up their productivity, use more of their capacity, utilize more of their capacity, right? Without having to reinvest in their companies to grow bigger to meet that demand, meaning that there's slack in the economy, meaning that, that's going to absorb some of the inflationary pressures coming our way. Namely, those caused by fiscal and monetary stimulus, devaluing of the dollar. So all these data points coming out showing that we're at this inflection point where the long term has seen a devaluation of the dollar. In the last 6 months or so, we've started to see yields go up as commodity prices have gone up in response to that weakening dollar. But now we're starting to see a inflection in those things, capitulation in those prevailing longer term trends. So does that continue, or is this just a breather before a resumption of the longer term trends? That's the $64,000 question, and that's what I'm spending a lot of time thinking about. Right now, the market telling us that in the short term, investor expectations for inflation moving forward have been squelched, right? So even though inflation is increasing and accelerating, it's not yet at a rate that is scaring the market. So the recent CPI data that came out, really just a classic example of expectations, right? So expectations had been for increased inflation, and that's what happened, but it didn't increase to an extent that was extreme. So the market is satisfied with that. So that's the current inflation situation and, the big catalyst for this move in yields this week. We also had retail sales and some other growth related economic data come out this week. So let's take a look. Popping back into the barometrics here, I pulled up retail and food services sales. This just came out yesterday, and we see a huge spike higher in the year-over-year rate of change, as well as a pop higher in the sequential rate of change, 9.82% month over month. So what does that tell us? It means that there's a return of demand, right? Retail sales are looking good. There's economic growth. So one more indication of an economic upswing. One last thing I wanted to touch on related to economic data before we move on to U.S. equities is this push and pull between housing supply and demand. So this top chart here is housing starts, and the bottom chart is monthly supply of houses in the United States. So think of the top chart as demand and the bottom chart as supply. So supply has been on the rise recently, while demand has been in decline over the last couple months. We actually have more data coming out today, so I'll be interested to see how that affects these charts. But basically, we're seeing supply, again here on the bottom, catching up with demand. Now, there's still an imbalance here where there's more demand than there is supply. It's been sending home prices soaring higher, especially with lower interest rates. Obviously, we've seen a back off in yields this week, but generally over the last 6-8 months, yields have been on the rise, and alongside that, mortgage rates have been on the rise. So we have this near-term move where supply is catching up with demand. Demand is being subdued by rising yields. So this is going to be an interesting story to watch play out, and should be hugely influenced by changes in the 10-year yield. So if we see a continued decline like we saw this last week, it's going to put less pressure on the demand situation, right? Lower interest rates cause a spike in demand for new homes because of lower mortgage rates. Conversely, if we have more supply coming online, that might also put downward pressure on home prices. But then we have the opposite thing happening, where if the dollar continues to devalue and the price of commodities go up, the types of commodities that we use to build new homes, that might put upward price pressure on homes. So again, a lot of very influential things happening in the intermarket picture that very much is going to affect the housing market. And the housing market is a pretty big deal. I mean, it makes up like 18 to 20% of GDP typically. So a very interesting narrative developing here in the housing market. So recapping the big picture here, yields backed off this week, commodities popped higher, the dollar moved lower over the last 2 weeks into this kind of near-term consolidation, and all in response to that, the US equities market blasting higher once more. So that's the current intermarket big picture setup. Let's dive into the US equities market to have a closer look at what's going on in there. Moving back into the bear matrix here, we're in the watch list section of the software, and here we can get a closer look at what's going on in US equities. Let's start with the major US indices, right? So the S&P 500 up 1.1% yesterday, being Thursday, up 1.8% this week, 5% over the last month. So a solid near-term uptrend in broad equities. Drilling down to technology, we see the NASDAQ here, more or less the same story, up 1.7% yesterday, up 2% this week. So more strength from technology as well. Looking at large cap, we have the Dow Jones here, up about 1% yesterday and 1.5% on the week, 3.5% on the month. So equities broadly looking really good this week. Drilling down to the individual sectors, let's have a closer look at the sector rotation to see what's showing leadership in the market right now. Right away, we see this big jump higher in healthcare this week. And healthcare kind of moving its way in the intermediate term from the market laggard to, in the near term, moving into market leadership. So an interesting sector rotation there. So let's dive in and have a closer look at what's going on with healthcare. We'll click the drill through function here. And yeah, so we see healthcare really blasting higher above the top end of its near-term range here on decreased volume on decreased volatility and increased volume. So a big positive push higher with tons of support here in healthcare. And this really has been developing since early March, where it's been in a kind of persisting uptrend ever since then. Series of higher highs, higher lows, moving from the bottom of its range here to above the top end of its range. So we'd probably expect some near-term weakness in here as healthcare takes a breather from this push higher. But definitely seeing support for that push higher on this increased volume and decreased volatility as price has spiked above the top end of its range. So a big positive signal in healthcare once again. Cruising back, what else is going on in the sector rotation? We saw materials and utilities in the 2 and 3 market leadership positions here in the 1 week return. So what's causing that? Well, utilities specifically because of all the inflation data we just talked about, right? Historically, utilities are interest rate sensitive, right? They have steady cash flow streams, so they can finance their businesses with a greater amount of debt so that they can be more profitable. But the downside of that is that whenever interest rates, the 10-year yield as a proxy for that increases, utilities companies generally are less profitable. So why are they doing so well this week? Again, we've seen yields move to the bottom of their range. So that's been a tailwind for the utility sector here. So I'd expect that next week we're likely to see a pullback in this utility strength because, again, yields are at the bottom of their range. They're more likely to edge higher over the next couple days into next week than they are to continue lower, just because it's at such an extreme. More importantly, let's focus on the intermediate and long-term trends in utilities. Utilities in the top 3 spot in the 1 month return as well. But waning, kind of leaning towards market laggardship in the intermediate term time frame, as well as the 6-month return and 12-month return, whereas the market laggard. So unless we see this near-term improvement, this near-term push to the upside persist and lead to a new intermediate and long-term uptrend, for now I'm still thinking this recent strength in the utilities sector as kind of a counter trend move, response to this capitulation in yields, which has been overdone, I think, at this point. So we'll see what ends up happening with utilities, definitely keeping an eye on the intermediate term and long term in that space. So materials, a similar story where materials are not to the same degree as utilities, but also interest rate sensitive. Infrastructure related companies are typically pretty interest rate sensitive because of the input price of the materials that they deal in. Let's consider copper, for example. When the dollar is down and commodities are up, a weakening dollar supports copper prices. With this near-term kind of reversal of the uptrend in the dollar and yields pulling back, both of those things are a positive for commodities. So companies like Freeport-McMoRan, for example, a copper miner, they're going to be more profitable when the price of copper is higher, right? So that's a good example of a materials company, and one tailwind that they would feel from these big picture moves in the dollar and the 10-year yield. Also related to this recent pullback in yields is strength in the real estate sector, right? And the number 4 market leading position this week. And again, I think that's fairly obvious why that would be. The lower the interest rates are, the lower mortgage rates are, the more attractive it is to buy a new home. So that supports demand in the sector, which supports the companies that provide homes, right? So strength in the real estate sector, we'll see if that continues, and will very much be a factor of the direction of the 10-year yield and mortgage rates. Beyond that, tech is a central part of what's happening lately. Tech has been up big the last year, but that strength waning in the intermediate term, right? So the long term is substantially up in tech. The midterm has been more mixed, right? With tech showing up in the middle here in the intermediate term, 3-month and 6-month time frames, but recently showing strength again. With on the 1-month return is showing market leadership. This week taking a breather a little bit towards the bottom half of the market, but still up substantially this week. And broadly, declining yields should support more strength in the technology space. The kind of narrative underlying that being that reduced interest rates allow growth-oriented companies to fund new growth at more profitable levels, right? So they can take out new debt at cheaper levels with lower yields. So the tech space likely to enjoy a favorable tailwind with a continued decline in yields. Definitely keeping an eye on tech to see if this near-term strength here in the 1-month return has some follow-through and starts to lead to even more outperformance in the intermediate term and long term. Lastly, I want to talk about what's going on in energy, which this week has been among the market laggards, although it's still net positive. The 1-month return has been a very different story for energy, where it's been the obvious market laggard. Down, what is this? About 5% over the last month. But we can see that over the 12-month and 6-month time frames, energy has done really well, up 60% over the last 6 months. So to me, this still looks more like a breather, right? Taking a break from the longer intermediate term uptrend. And we saw a huge spike higher in oil yesterday on, again, the CPI data that came out. So let's take a closer look at oil. We'll come up to the watch list here. We'll go over to commodities. Cruising down to oil, we see it was up 0.5% yesterday, but up 6% this week. So, a big pop higher in oil. Let's drill down and take a closer look at the chart there. Hit the market drill through, let that load up for a second. So you can see oil prices absolutely tanking around the coronavirus fallout, edging higher ever since. If we move this to the beginning of 2021, have a little better look there. So oil kind of peaked in mid-March here, corrected for about 2 weeks into late March, and has more or less consolidated since then until popping higher this week. So the first signs of life in several weeks from oil, which obviously has implications for the energy sector. Because generally higher oil prices are going to lead to greater profitability from companies in the energy space. So a big positive sign for oil, and again, that's very related to this move higher in commodities and this reversal of the near-term uptrend in the dollar. So it's all connected, it's all related, and we're seeing oil pop higher. So definitely keeping a close eye on the direction of oil. Likely to have a few days of weakness in here because, it's at the very top of its range, and it's likely to mean revert back towards the middle of its range. What happens after that is what I'm curious about. Does oil continue along its long-term uptrend after this intermediate and near-term consolidation? or does it break back down? So that's going to have wide-ranging implications for the energy market and the phase of the business cycle that we're in as well. So definitely keeping an eye on oil and energy. One last thing about oil before we wrap up there is that OVX, the oil volatility index, is below 40. In fact, it's down near 34.5 or so as of Friday morning. So reduced volatility in the oil space on this price move higher, and that also being met with increased volume on the price move up. So plenty of support for this move higher in oil. And the same goes broadly for equities, with the VIX down near 16.5 of this morning. Generally anything below 20 in the VIX is the all clear signal. Vol has spiked a little bit, kind of detaching from this move in VIX, right? So vol is the volatility of the VIX index. So we're seeing a spike higher there. In my opinion, that's still just kind of Brownian motion, meaning just, it's kind of meaningless coming from nowhere. So unless we see that bleed into a spike higher in VIX, I'm not too concerned there. We also see a reduction in the VXN, right? That's the NASDAQ volatility. So volatility on the NASDAQ index, NASVOL, down 7% week over week, supporting this move higher in tech. Well, we saw that that's taking a little bit of a breather most recently, but broadly, this more recent push higher in tech on decreased volatility is a good signal. So volatility broadly still subdued and indicating to us that we can lean into our long positions, that there's less fear in the market right now. So with all of that said, what to watch this week? First up, and kind of the genesis of all of this, is the direction of the US dollar. Does this week's weakness continue, or do we resume the near-term move higher? That will have broad implications across asset classes and the stock market. So if we see this recent strength in the dollar start to flatten out, or if the dollar starts to edge lower, that would be a continued tailwind for commodities, for the price of oil. That's going to have implications about the direction of yields. So definitely keeping an eye on the dollar. See if the near-term consolidation resumes kind of the near-term uptrend, or if all of that resumes the prevailing long and intermediate term downtrends in the dollar. So a lot to be watching there. Again, if the US dollar near-term strength subsides, expect continued strength in commodities and oil. The 10-year yield, on the other hand, is at an extreme. So it's below the low end of its range as of today. Bouncing a little higher this morning, but it's creating a higher probability of a pop higher as it mean reverts next week. So being below the low end of its range means that it's more likely in the next couple of days anyways to move higher, because it's at an extreme, right? My view is that yields are likely to edge higher in the intermediate and long term. So we're at the low end of the near term range, but I think we're going to expect a move higher and a sustained move higher as inflation continues to increase. However, we have all these kind of pressures that are ready to absorb inflation. So I don't think inflation is going to really take off for several more months at minimum. So I don't think that we're going to see yields getting to scary levels anytime soon, but I think that they will edge higher over the intermediate term. So what does that mean? Well, there's a lot of implications about what changes in the 10-year yield means. So if they continue higher, it's going to continue to put downward pressure on the utilities, REITs, and infrastructure related companies, interest rate sensitive companies, right? Conversely, if yields go higher, that's going to support financials, banks in particular, who become more profitable in higher interest rate environments because they can make a bigger spread between the interest rates that they're paying out on the deposits in their banks and the interest rates that they're taking in on the long-term loans that they write. So keeping an eye on 10-year yields and how that's likely to affect those sectors of the market. Lastly, I also have a pretty close eye on technology and discretionary, who have both been showing signs of strength lately. If yields continue lower, that will be a supportive tailwind for technology and discretionary. But even if yields turn higher, these two sectors can also go higher along with them. So, you know, they're both in long-term uptrends. They've consolidated over the last several months in the intermediate term, showing some near-term signs of life again. So if this near-term strength continues, I think there's gonna be a lot of opportunity in technology and discretionary. So with all of those things in mind, what am I gonna be doing this week? Action items for you guys. So again, sector rotation favoring tech and discretionary as of last week. That waning a little bit this week, but I'm still looking to buy on weakness while always keeping an eye on volume and volatility for support in those price moves. So yeah, I'm still looking to leg into tech and discretionary. Energy, in my opinion, is set to pop higher, and here's why. With the sector consolidating on decreased volume and decreased volatility, that's a positive sign, right? That the prevailing long-term trend is likely to continue. So oil in a prevailing long-term trend, and energy, you know, the energy sector in general in a long-term uptrend. So this recent consolidation, the volume and volatility coming out of those things, and then we saw a big pop higher in the price of oil this week. So I think that's going to lead the energy sector higher over the next couple weeks in particular. There's a lot of opportunity there and a higher probability that we continue higher in energy and oil than a continued consolidation or a leg lower. That said, it's at the top of its near-term range, so today is not the day to buy energy, but definitely a favorable setup in that space. Also, financials are going to be influenced by the move in yields. So yields being at the low end of their range, at an extreme low end of their range, they're more likely to mean revert and turn higher over the next couple days. It's creating a nice entry point into any financials companies, specifically bank stocks. So if you're interested in entering new positions in financials and bank stocks, this is looking like a pretty good entry point. With yields set to pop higher and financials kind of in the middle of the pack as far as market leadership. That's it for this week, gang. Plenty to be thinking about and plenty of opportunity out there to act on. So if you guys like this video, don't forget to subscribe to the channel, hit the like button, check us out over at marketbarometrics.com. Have a fantastic weekend, and we'll see you all next week on The Big Picture.